Figure out what your clarity is first, where you want to go, and then seek out those types of people that you think can help you get there, and just take action when they tell you to take action. It won't be perfect. Don't let that hang you up. Just evolve along the way and pivot if you need to as new information comes to you.
Welcome to Truly Passive Income. I'm Neil Henderson.
And I'm Clint Harris. And today we have two guests. We've got Ryan Twomey and Lucas Ravanis. They're with us. They're the co-founders of TR Capital Partners. They started with house hacking small multifamily properties. It's a strategy near and dear to Neil and my heart. They scaled to co-own over 500 units in 4 years. Ryan's expertise in syndication and investor education, combined with Lucas's background in sales and relationship building, has helped them create opportunities for passive investors to grow wealth without landlord headaches. Gentlemen, thank you for joining us. How are you today?
Doing great. Thanks for having us.
Super pumped to be here.
Excellent. Excited to have both of you. So thanks for that. 4 years, 500 units. That's great. First of all, congratulations. I'm excited for you. Tell us a little bit about yourselves, how you got started, how you guys partnered.
Yeah, so I guess I'll start. Me and Lucas have known each other since we were, 7, 8 years old. So we go way back as far as that goes. But really, a little bit of background on myself. I started my career in financial services, doing wealth planning for a bunch of different types of investors of all different net worth levels, and then later transitioned to a role with the parent company of the New York Stock Exchange. And the jobs paid well, but took up pretty much all of my time. So with the goal of controlling my schedule, I began investing in real estate with Lucas to have those properties pay for my lifestyle, essentially. So, and since we've been syndicating, then we've been able to quit our jobs, start our own company, TR Capital Partners, where we've built a community of like-minded investors and have control over 574 units that pay us every quarter, with a larger goal of adding another 1,000 units over the next 3 to 5 years.
Very cool. So, as we said, house hacking is near and dear to mine and Clint's heart. And to me, it's the secret to a lot of real estate. I always tell people if I have anybody who's asking me how to get started in real estate, I'm always like, well, what's your housing situation? I rent, okay, was there any way you can buy a small multifamily, whatever? When did you buy your small multifamily? I'm just curious.
Yeah, so our first investment was January of 2021, so right in the middle of COVID.
All right, so we're not talking, we bought a fourplex back in 2013 when it was $100,000 and now it's worth $400,000. This was not the peak of the market, but it wasn't cheap, correct? And you're in Massachusetts, which is well known for very, very inexpensive real estate. Yeah. Talk to us a little bit about, give us some details, some flavor about what that was.
Yeah, so going back to COVID, right? So everybody's at home. Ron and I, like you mentioned, we grew up together. And at this time, we're both living at home with our parents. And I wanted to get out of there, right? So I actually reached out to Ryan asking if he wanted to find an apartment somewhere. Ryan had the bright idea to, hey, let's buy a property, right? And that was a light bulb. Like, you know what? Maybe we should learn to be landlords. So we would meet up, learn about real estate, learn how we can get into the game, found, some contacts to get us in touch with some brokers. And we ended up finding a nice triplex in a town called Worcester in Massachusetts, where we were like, hey, this is a great opportunity for us to buy this property, live in one unit. So that's the goal, right? We're no longer living with our parents, but also we can rent out the top 2 units to pay for our mortgage, right? So we'll be living for free. That was great, right? That was the idea. And we executed that. Buying that property was really fun. We lived in the first unit. We realized we had 2 really crappy units above us, and we bought that house with maybe a hammer to my name, right? So renovations were built off of YouTube tutorials and then paying friends who are contractors with beer and pizza, right? And it was a super fun time just learning the processes of how to do it. But it was really, once we house hacked, we realized, wow, there's a ton of benefits when it comes to investing in real estate, right? And that kind of sparked TR Capital Partners and our idea to grow with bringing investors on board to buy properties.
And both those, in the triplex, the units above you were all long-term rentals?
So we did month to month, but one unit we rented out in 2021, they've been there ever since, right? So we've had turnover in one of them, but yeah, they're month to month. Was the case of Massachusetts laws, sometimes tenants can take advantage of you, so we didn't want to cross that line. So Luckily, we've had some pretty solid tenants.
You guys did great. I'm excited for you. I'm older than you are, but I started kind of the same. I'm 42 with 2 young boys and married and for 13 years live at the beach. But my wife and I, when we were just dating, my first house when I was 24, 25 was a duplex. So I lived in one half, rented out the other half, lived there for free. Thought I invented this concept. I was a genius. And then I went through a series we had 9 single family homes. And then in 2017, I took a promotion. We moved to the beach. But that first house hack and the idea of never having a mortgage, it does not leave you. After you haven't had a mortgage or you've been paid to live in a property, you never forget that. And so in 2017, my wife and I moved to the beach and we bought a duplex 2 blocks off the water in Carolina Beach. We lived in one half. We did Airbnb with the other half. And that it did 3.5 to 4x the gross potential rental income is when it was a long-term. So it paid for the whole property, taxes, insurance, utilities, and obviously highly seasonal, but over a yearly average, it paid us an additional $1,400 a month on top of that to live there. And if you are young, the number one thing that we talk about is like, yeah, you can, people saving their money to go buy a property that they're going to burr and they're going to refinance and, pull all their money out. They're cannibalizing their monthly cash flow to get their capital back out. Maybe they're going to cash flow a couple $100 and they're paying $1,800 a month in rent. It's like, what are you doing? Like the average person these days is spending around 30% of their income on their housing expense. You can never go find a rental property that's going to pay you 25 to 30% of your income, right? But you can eliminate that expense through housing. So you're also not going to find an employer who's going to give you a 30% raise. It just doesn't happen. So the number one thing that you can do is eliminate your housing expense. There's a couple different ways you can do that. We've had people on here that have house hacked by buying a 5-bedroom house and renting it out by the bedroom to college students. I did it with short-term rentals. Like it wouldn't house hack as a long-term multifamily, but when we converted it to Airbnb, the gross potential rent shoots up. The cool lesson after that, you guys did a triplex. That's great, right? You got 1 unit, you got 2 units to offset that. So that's beautiful. The part I'm interested in is that you guys moved past that and quickly got to commercial, because that's really the key. Like if you're looking at a triplex, what is the valuation of that triplex? It is the bricks and sticks and the comps. What did the neighbor pay for theirs, right? What are the other properties on the street? There's probably limited multifamily in that market, at least compared to single family. And on a 3-unit, it's the bricks and the sticks and the comps. That's it. What about if it's 4 bedrooms or more? 4 bedrooms is the cutoff that can either be commercial or residential. So you can get a regular residential mortgage on a 4-unit. And I still own a duplex and 3 quadplexes at the beach that my wife, we started those. They're all Airbnbs. Then we started a property management company and then built ourselves a house. But that 4-unit, you buy a 3-unit for $500,000 and you fix it up, you make it nice. Maybe it's worth $550,000. But you take a 4-unit, say it's like $600,000, and you make it nice, you stage it, and you get a commercial appraisal on it. It might appraise for $1.3 million, because as a 4-unit, it can either be residential or commercial. So when I maximize the net operating income by maximizing the rent or decreasing the expenses, that net operating income multiplied by cap rate multiplier recently puts a valuation on that same property is 1.3, 1.4. That lesson is usually the next lesson that comes after house hacking, especially for people that did it with multifamily and not just renting out bedrooms. And you guys really have moved fast past that into a co-GP model and multifamily. And multifamily is like 500 units. We use the analogy of Ryan Smith is a operator with Elevation. And he had as an analogy that I love, that he takes his kids to a Walmart parking lot and he gets them out of the car and he tells them to go walk around the parking lot until they find $1. And they're like, $1? Why do I care about $1? $1 is just $1. But his analogy is that at the time, self-storage and RV parks were trading at a 5 cap. So it's like, if you take a commercial asset and you increase the rents of that commercial asset by $1 a month, what does it do to the value of that property at a 5 cap? That $1 a month on a single family rental is $12 a year, and nothing happens to your valuation. You just get an extra $1 a month. But on a commercial property, $1 a month is worth $240 to the value of the property at a 5 cap, which means $1,000 a month is worth $240,000, and $10,000 a month is worth $2.4 million to the valuation of that property. And if you can increase that net operating income, the bank will immediately give you a valuation on that of $2.5 million more that you can refinance and pull the money out. So I'm talking way too much. I'm excited.
We got him on a roll.
But then this is, I'm reading your bio here, and I'm seeing like the linear progression that you guys are moving forward. You're doing it very, very quickly. So talk to me about what you guys are doing now. The other thing is like, it's pretty rare for me to see a couple guys your age that are dabbling in multiple asset classes. So you're clearly like, you're not afraid to move quickly. You're not afraid to fail and fail fast. Tell me about your trajectory and where you guys are headed.
Yeah, I think, well, going back to your example of being able to control the valuation, that was a light bulb for us. So once we learned that, we were like, we got to go into the commercial space because we have far more control over the asset itself. Plus at scale, obviously, you say you have 50 units. If 2 tenants move out, doesn't really impact your cash flow that much. It all stemmed from, we went through an eviction in our triplex. We lost 30% of our income right there. It lasted like 7 months. She didn't pay us rent. But it's Massachusetts, so you have to go through all the red tape. So that's when we knew we had to completely pivot in our approach. So we actually started networking and sought out a mentor, got a mentor. He helped us revamp our business, essentially acted as a business coach and mindset coach for us. He got us from that scarcity mindset, from thinking small to thinking larger into these properties. And then from there, we just completely revamped how we were doing things. And we're very intentional about building out our network and community of investors that invest alongside us to take down these larger deals. And a lot of it came from being more educated in what we were doing. You know, everyone that I know, for the most part, they follow that traditional landlord route. They think that you have to be a landlord to get real estate benefits, but that's not the case. And we went through all the headaches and the hassles. So now we look to provide people with the benefits without the evictions and the maintenance and the tenants and all of that stuff, because you don't have to go through that, and you can still get the same powerful wealth building benefits it offers.
For people looking to follow the same pathway, you talked about identifying a mentor and somebody that could really help you move past a scarcity mindset. Which the most important thing there, in my opinion, is that the amount of time that it's saving you, right? It's the speed of being able to learn from their condensed life experience that can move you past the obstacles of having to learn a few hard lessons yourselves. Being younger guys compared to a lot of the investors that we talk to, what advice do you have on finding a mentor or identifying somebody that can help you with that?
So I'd first start with something our mentor told us. Dial in your what, why, and how. First, what do you want to do? Why do you want to do it? Who can help you, and how are you going to get there? Then proactively seek out those people. So they're going to be the people that they've gone through the failures. They have the experience. They have all these things that, again, like you said, it's like a cheat code. It speeds up your progress because you can learn from them. And for the most part, they have connections that you don't, that if you're proactive and you're showing that you're a go-getter, action taker, they might make those introductions for you, which will just further enhance your growth. So figure out what your clarity is first, where you want to go, and then seek out those types of people that you think can help you get there, and just take action when they tell you to take action. It won't be perfect. Don't let that hang you up. Just evolve along the way and pivot if you need to as new information comes to you.
Lucas, anything to add there?
Yeah, I mean, I think clarity is the biggest thing, right? I just kind of want to touch on what Ryan said more, right? If you don't have a goal in mind, what are you trying to accomplish? So it's important to sit down and understand what it is that you're trying to do. For us, our what, why, and how, right? Our what was we wanted to create a real estate business. Our why is we wanted to leave our miserable W-2 jobs, right? And also have more passive income streams and work for ourselves, right? We wanted to create a legacy. How? Well, that's what we had to figure out, right? We're going to leverage the knowledge of others to figure it out. And we only got to that point through going through the smaller multi stuff, right? Because when we had that triplex, our idea of scaling was, let's save up enough money to buy another property, which we did, right? And we bought another duplex. We house hacked that as well. But now that we weren't living in that first property anymore, all those landlord horror stories started popping up and coming to fruition, right? It's a lot easier to be a landlord in the house that you live in rather than having to travel to that property to fix a leaky toilet on midnight on a Saturday, right? So we had those landlord horror stories, and then we realized people don't invest in real estate because of what we've become. People have the idea and the connotation of real estate and landlord, right? People don't do real estate because they don't want to be a landlord. So we had to figure out a way to, if we want to get people on board, how do we do that? And we take away the means of them not wanting to invest right away, but still give them those benefits, right? So it was just going through the motions of trying to figure it out. Once we did set our goals, and then after that, I mean, Ryan and I are both go-getters, right? It was head down, full steam ahead. Let's go make it happen.
There's a life-changing book that Clint and I talk about all the time called Who, Not How. If you've never read it, I highly recommend it. And what essentially, even if you aren't familiar with the book, what you guys did was exactly that. It's like, all right, here's what I'm trying to do. I can either spend 3 years learning how to do it, or I can find someone, or do a blend of this. I can find someone who knows how to do it, who either is going to actually do it for me, or who will teach me how to do it. In an accelerated fashion, because there's so many people, they get into this, self-help mentality, and by the nature of the internet, we're able to look up everything, and they'll spend years trying to figure out how to do something when you probably would have just been better served figuring out somebody who already knows how to do it. And that's maybe not your zone of genius. Hey, I don't know how to raise capital. Well, but I know how to manage a property. I know how to handle CapEx and things like that. What if I go out and just find somebody who already knows how to raise capital, which is oftentimes sort of when we get into the co-GP model, is you find somebody who knows how to handle investors, and you just go out and have them do it for you. Correct?
Yeah.
Yeah. I mean, it's a team sport, right? As you scale, it's like with the triplexes and duplexes, Lucas and I could go to the bank. We could go get the loan. We could go manage it ourselves, especially living there. When you go to the commercial assets, especially if you're new, you need to find someone that could be the key principal. Probably need to find an asset manager. Probably need to find a property manager. Probably need to find all these different things and create a team of people that's going to actually be able to serve those investors you bring on. Because if you're trying to do it yourselves, you're most likely going to underperform, because it is a team sport when you get to that scale. But again, going back to the who, not how, surrounding yourself with the right people and filling those gaps that you need is a huge part of the plan. So making sure you're clear on what that is pretty much the first step, in my opinion, and it's served us pretty well.
Yeah, I think that there's something else to unpack here. Is that the book Who Not How by Dan Sullivan and Ben King had a massive impact on me as we were building out a property management company. But anybody in an entrepreneurial journey, you're asking yourself, how do I do this? How do I do that? How do I do this? It's 1,000 things. And the real question is, I don't need to know how to do all that. I just need, who do I have that's better at those things than I am, right? And that's one of the benefits of identifying a mentor and someone that can help you think past your own limiting beliefs and push you forward. But you mentioned something earlier that this really, it brings up, and it's a fringe benefit, in that there's a saying, and people say, if you want money, ask for advice. If you want advice, ask for money, right? If you go to somebody and you're like, hey, can you invest into this deal? They're going to be like, listen, let me give you some advice here. And that's all you're going to get out of them. But if you go to them and be like, hey, listen, this is what we're trying to do. This is what we're trying to accomplish. Would you be willing to mentor us or give us some of your condensed life experience and find us a way to help create value for you in the process of taking down this? Next thing you know, they're not only willing to help you, they're willing to invest in it, and they're willing to bring other people to invest in it. And it's really smart. It's disarming when you go to people. There's a guy named Dan Pearson that we've interviewed before with the Pearson Equity Group. And one of the things that he did that I thought was brilliant is that he went and he created a board of directors. He was a young guy trying to put together a fund together. And he identified 4 or 5 people that have a net worth of over $100 million combined. And so he's built what he calls a $1 billion boardroom of a combined group of people with, $1 billion net worth that he can go to for advice. And he's like, look, I will never ask you for money. I don't want you to pitch my deals. I just want to be able to have a call with you quarterly and get some advice as to how you think I should handle these different challenges. They're all willing to help him. And what's the end result? Do you think those people ended up investing in his deals? Do you think those people are more than likely to send their other centimillionaire friends to invest in his deals? Yeah, there's continuity there because he went to them from a place of humility of like, how, of everything that you have to offer, you are worth $100 million. Of everything that you have to offer me, the most valuable thing I could possibly ask for is your time and experience. That is a great place to start. And that's a way to build synergy with the people that are guiding you along, that they want you to have success. So it's not just, it is a time warp. And that's the biggest thing. Like, how do we fail fast? How do we move forward to find out, what kind of investor are you going to be 20 years from now? It's going to be a combination of the content you consume and the people you surround yourself with. And be willing to ask for help from people that, yes, of course you'd like their capital, but there's something that's so much more valuable than that that's going to help you in your long run. So I think that's brilliant. Just want to acknowledge that. The other thing that I'm curious about is, first of all, 2021, when did you do your multifamily project? Was that 2022?
The kind of a timeline. The first one was 2021. That was a triplex. Then we got the duplex. And we started the TR Capital Partners business last July, so almost 19 months ago. So it's moved relatively quickly, but we have definitely failed fast and along the way. So don't get that mixed up either. We've learned our lesson on quite a few things.
What a time, man! In terms of economic headwinds, the last 12 to 18 months has probably been the hardest time in commercial real estate, at least in the last decade. So it's one of those things that you guys probably don't have a ton of fixed overhead right now. But the reality is, if you can make it work right now, you're probably really sitting pretty in the next 5 years, because we've seen a lot of operators go dark and not be able to operate in the last year or two. So maybe you timed it perfectly and you're just getting started on the back end of a bad time. But this is kind of the equivalent of becoming a real estate agent in 2009. It's a tough time, right? And you guys have been able to pull that off. Multifamily especially got smacked. Right? It's tough. So how did you started with a co-GP in multifamily, and you've also done an RV park. Talk to me about that. Did that happen by necessity, or why the diversification there?
So I'll start, but Lucas can chime in too. We actually, our first deal we ever were going to do as a co-GP, we failed at. So we were going to do a small property in Idaho. Our team in general couldn't come up with the capital. The lender pulled the deal from us last minute with a week to close. So I was literally making breakfast and got that phone call. Lucas, I was living with him at the time, had to tell him, and we were crushed. But because we have relationships with other sponsors, we told them what we were doing, built in our network over that time period. We actually got referred to Servio Capital, which is the RV resort, about 2 months later. After they heard about the story, we told them kind of what we've been doing, what we're looking to do in the future. He gave us another shot to be a co-GP. We ended up getting all the capital in to close on that deal. We help with the asset management, investor relations on that now. And that was kind of our very first deal we actually closed on. From there, we have scaled up through mostly multifamily, which was our original decision. So I wouldn't say it was out of necessity. It just happened to be the opportunity that came to us through a referral. And we were just eager to get back on the horse because we didn't want to sit in that loss for too long.
Yeah, it comes down to the power of networking, right? So the first thing we did when we decided that we wanted to become syndicators for multifamily apartment buildings is we wanted to network with a bunch of sponsors, right? We wanted to figure out what their buy boxes were, how we could bring value to them to incentivize them to bring on TR Capital Partners, right? So because we were in a position where we came up short on a raise, but we were already networking with sponsors, we were able to leverage our relationships to get another shot, right? And it was an opportunity that came to us where we weren't going to say no to, right? And as soon as we could close on a deal, we knew that we could leverage that for credibility for future opportunities. Because in this line of work, right, the first thing you do when you talk to investors, they ask, what have you done, right? Well, if you haven't done anything yet, it's kind of hard to come up with that decision or that answer, right? So you leverage what the sponsor's done. So we knew if we could get on this opportunity, which was a great deal, by the way, it still is a great deal, we were able to leverage that for our credibility, our brand, and that would help us speed up the process of onboarding new investors and bringing on more investors to our deals.
is your model as a co-GP model, and maybe you've looked at fund to funds as well, but your model is you're providing access to your investors. Either you're offering them a better return than they could get on their own by going straight to that general partner, or you're offering them access with like a lower minimum. If it's a $100,000 minimum, maybe you're doing 25 or 50 or whatever it may be. And you're bringing a pool of money, say $1 million that you're bringing together to an operator. So you're going to get preferred terms because of that. And then you get a piece of that, and your investors are, I'm assuming that they're getting probably a better return than they would have gotten if they gone straight in with 50 grand of their own. Is that how it works?
Yeah. So it's a little bit of a mix. A lot of it had to do with getting them in at a lower amount. So a lot of the like friends and family, for example, they were trying to invest 25,000 per se. If you go right to the sponsor, unless they know you personally, you're probably not going to get in on that deal with that low of a price. So that was part of it as well. As we primarily do 506Bs for that reason. We want to be able to have everyone within our network that we've established that qualifies for these types of investments in our eyes to be able to get access to the opportunities. So that is pretty much part of our model, is being able to get them in at a lower price. And that's essentially through the relationships we're building with the sponsors one-on-one that they just haven't been able to or just don't have access to.
So you're creating that, you're raising capital from your investors, 506B. Is the total offering a 506B, or are you starting it as a 506B and then it's being converted to a 506C after you hit your limit of 35?
Yeah, we've done both. We've done straight out 506C to start. We've gone 506C converted to B. For the most part, because we are really ramping up our brand as more of an investor community, we're more hands-on with our investors, right? We don't want them just to be thinking as investing capital and then we just keep them updated, right? We want them to actually be a part of a community. So by doing that, we're really leveraging our relationships with them, right? So we're very intentional with who we have invest, making sure everybody has the right mindset. So we've been heavily focused on 506B for the purpose of, helping more people with not that much money as an accredited investor get to that level, right? And then through that referral programs, right? But yeah, we've done both, but the primary focus will be the 506B.
Yeah, I love that. We started the same way. We specifically focus on buying old Kmarts and grocery stores and warehouses, and we convert those vacant buildings into climate-controlled self-storage. We're buying these buildings for dirt cheap. So we started off 506B too. It's near and dear to my heart. Our average raise was only like 1.5 to 2 million. So it's easy to do that with small minimums and from a small group of friends and family. We hit a bottleneck that as we grew and we started doing a fund, we had to turn that into a 506C and convert, so that we could do that general solicitation. But in terms of grassroots efforts, first of all, friends and family is always the path of least resistance in terms of the ability to get started there. And then it's from there, you're going to scale and you're going to grow. But I love seeing people always continue to make a place for those investors and work to turn those non-accredited investors into accredited, right? Move them into that space. So now we're sitting at 150 million in assets under management. And, on the way towards 500 million and then $1 billion. And you get to a point where you can't continue to do that to hit your scale. You have to start raising capital in faster clips, which means doing general solicitation. But if you always make sure that you maintain a place for those people that you started with, especially if we all want to be doing this for a long time, those relationships are worth more than anything else. And how cool is it when you find the non-accredited investors and all of a sudden they are accredited, right? Because they've done a few deals with you. So that's great. So what's next? What are you guys looking for in the future? What's coming down the pipeline? What kind of, we have a lot of operators that we're friends with that we've interviewed here and then listened to. What kind of operators are you looking for? What kind of deal structure are you looking for? How much capital are you guys looking to raise?
Yeah, so right now we're working a lot in Springfield, Massachusetts. That's our main goal. We have a ton of relationships with not only the property management and subsidies in that market, because we're taking a little bit of a subsidized housing route, but we're looking to acquire about 1,000 units in that market in the next 3 to 5 years, with the primary focus on affordable housing, subsidized housing, whatever it might be. That's because the state has been pumping money into all the major cities in Massachusetts over the past couple decades to revamp them, modernize them, just give them a facelift, essentially. So it started with Boston like 20, 25, 30 years ago. That's pretty much done. Not sure if you've been there lately, but it looks amazing. Worcester's next. So that's actually where I live. That's in central Massachusetts. If you look around just the past 4 years, the amount of development going on is just insane. And the next city that's on the list is Springfield. So they're slowly moving from east to west. And once we're looking to get into that market, essentially before the growth is priced in, but we know it's on the horizon. So we know we're kind of projecting this out into a 3 to 5 year timeline. That way, when we can sell the properties and typically about 5 to 7 years, we can hit that 2 to 2.5x equity multiple for investors at that time. Plus, they tend to be smaller assets because it's just the city itself has those types of properties. So we're looking at, 40 to 80 unit buildings. So again, going back to the raise sizes, we can kind of stick with that 506B model because we're not raising $20 million for a deal. We're raising around that 1.5 to 3, maybe $3.5 million for those opportunities.
Gotcha. So, I don't know what the latest numbers are. The numbers I hear, like 6 million housing units is what we're short in the United States for what we need. And it shows no sign of abating. And there's all kinds of, solutions people keep throwing out: deregulation, anti-NIMBYism, subsidized housing, from all sides of the political spectrum, you're getting ideas come in from it. What is the state of Massachusetts? What's that opportunity look like?
So I'm not sure if this is statewide. However, in Springfield, there's a lot of subsidized housing opportunities. I think there's like maybe 20 different types of hyper-local subsidies you can work with. And that's because they're looking, again, there's a shortage. There's people that need help with paying their rents. And in order to give the city a facelift again, they're trying to incentivize landlords or operators that actually care about their buildings or the community, that want to make a bigger impact, as opposed to what they've had in the past, which is someone that kind of neglects or is a slumlord per se. So they're trying to push those people out and incentivize people to come in through those subsidized programs. So that's the model we're going to be following in the future. And mainly it's because, similar to the tax code, the government has things they incentivize you with. So we're just going to follow that playbook and take advantage of what they're going to be able to give us, because we will be able to benefit from those incentives and the opportunities they present down the line. So that's kind of our main focus right now.
One thing about subsidized housing is, a lot of times people hear Section 8 and they think of the horror stories and everything come along with it. And I'm a firm believer that there is a right way and a wrong way to do it, and that the wrong way can lead to being a slumlord and taking advantage of people, and it's horrible. But the reality is that there is a need for the right type of people. And especially when you screen and you get the right types of tenants, a lot of those tenants end up staying in the program for more than 6 to 8 years. Because if you ever get kicked out of the Section 8 program, it's unbelievably difficult, if not impossible, to get back in. So a lot of those people don't want to mess up. Now, you have onus on you as the property owner as well to make sure all the windows open and you're passing the inspection and everything else. But one of the things that is interesting is, if you do a good job picking the right property with the value add and the management, and it's subsidized housing, a lot of times these people have a longer stay than your average tenant, which means this is a potential really good investment strategy for anybody using self-directed retirement funds. So I'm curious to know, I know that that's part of your plan, is that you guys take self-directed retirement IRA, 401k funds. For people that have retirement accounts, traditionally, they could only invest in stocks, bonds, whatever it may be. Now they have the opportunity to self-direct those funds and invest in real estate and businesses or anything else through a third-party sponsor. So I'm curious to know what your pitch is and how you talk about this when you're talking to people that are thinking about using retirement funds. What percentage of the capital that you raise is from those retirement funds, and how does that conversation go?
Yeah, so I would say majority of our investments come from self-directed IRAs. And that's simply because it's our pitch to people, right, for our investors is, you have access to capital that you're not aware of, right? People don't realize that they can use a 401k from a previous job and use that to invest into syndication deals. Now, it is important to know each retirement plan is different. So for the most part, if you're actively contributing to a 401k, it's going to be difficult, if impossible, to convert that to a self-directed IRA. However, if you have job hopped and you have a 401k from a previous employer that's just sitting there, there's a great opportunity to make your money work harder than you, because in that 401k, you're making what, like 4 or 5% on it? Well, in real estate syndications, our target models are 18 to 22%, right? On top of that, there's a 2.5 point equity multiplier that we target for returns. And it's just, you don't get that with just having it invest in stocks, bonds, and mutual funds, right? It comes down to the saying that I live by. I love saying this to people is you don't know what you don't know, right? So it's our job to get in front of people and educate them on different aspects of investing, right? Real estate's so vague. We love syndications, but there's so many different things you can do, but you can access these investment opportunities through capital that you're not aware that you have that's available to invest. So majority of our investments do come from previous 401ks that are converted into self-directed IRAs.
I love that. One caveat I would add there is that one thing that we've heard about recently is that even if people have not job hopped and they're still in the same job and they're contributing to the same retirement plan, a lot of times that's going to limit their ability to invest that, with the exception of, and you have to ask each individual company because they're different. Sometimes if you have an employee match and you've been maxing that out or even less than maxing it out, they won't let you take your funds that you've invested into that self-directed or in that retirement account and invest them, but they sometimes will let you take the company match. So let's say that you've got $500,000 in your retirement and the company match over years has put in $100,000. They may not let you touch that 500, but you potentially can take that $100,000 match and turn around and invest it. They don't oftentimes like you to know that, because the custodian doesn't want to lose that $100,000 out of their ability to make commissions. But if you've never left your job, you've got a retirement account right there. They're going to tell you, oh no, it's only after you've left your job. You can self-direct that. But ask the question about the company match dollars, because a lot of times you can direct those dollars and do whatever you want to with it. So just a tidbit that we heard recently. So I love that. And I think because of, you guys are fairly young, a lot of times it makes sense that your population is going to be your parents' age friends that have retirement accounts. And like, these days betting it in the stock market with paper assets is a little scary, right? So it seems like a really good time to take something and leverage it against, it's called real estate, right? It's not called real stocks. Being able to leverage against something where you can control the operation. Tell me about the RV parks. What's the value add strategy and the exit there?
Yeah, this one was a little different than our typical strategy. It's not like a light value add where we're doing some renovations, cosmetic stuff. We actually did a full reposition on this one. So we purchased it for $4 million, actually raised $9 million. And the whole thing was to completely revamp the park. It was a 435 unit RV resort, had 77 cabins on the site that haven't been touched since like the 70s or 80s. They're like yellow and pink and blue. They just look disgusting. So the whole plan there was to go in, renovate all the cabins.
Lucas may have to get you to jump in there. I think we lost audio for a second.
So a part of what we did is with the renovations, the whole goal was to return investor capital quickly. So we had a 12 to 18 month time frame. It was a 506C minimum, 100,000 investment. So what we did is there was 100 units on the property that were for long-term rentals. And right away, the first thing we did is we put a fence around those 100 units and we sold them off for $4 million. So bought it for $4 million, just sold a quarter of it for $4 million. Now every investor's in the deal, risk-free, all their capital back. We're ballparking a 4.25 equity multiplier by the time we sell it. What we did with the cabins on site is we hired a production company and interior designers from around the world to come in and give them 30 days to renovate the cabins with a $20,000 budget. We filmed a show called Cabin Wars, Flip It to Win It. The winner gets a $50,000 cash prize. Discovery Channel picked it up. They air it every Wednesday at 8 p.m. Eastern time on their sister channel called Destination America. So that was a huge thing for marketing, right? That right there. So this one was a totally different play than the value add, but still an incredible opportunity.
I love that. How cool is that?
Yeah.
What a American way to get that done. Get what you want and have somebody else pay for it and get paid for the entertainment. What about the RV park portion? I've got a friend specifically picking up RV parks right now. What's going on with the RV park and how many slips are there?
Yeah, so we have a mix between long-term, short-term, vacation, a couple weeks at a time, a couple days at a time. But the cool thing with RV parks is the the upkeep is very low, right? All you have to do is we had to renovate the concrete slabs, update the electrical boxes, keep everything nice, neat. The layout's great. There's like 7 swimming pools there. There's a couple of shops. We have a lake. We have a nice little pond there as well. So our focus was to add as much value add to the property as possible for the tenants to take advantage of. So we installed a lazy river around the pools. We installed a trampoline park, right? We have zip lines. So we wanted to bring as much fun and pack stuff inside the park that we can charge the tenants to use, right? And it's not a high fee, but if we're going to have it there, a couple of bucks here and there, we'll say there's 300 units, right? If there's 3 people per RV, right, there's $900 if it's just $1. So just do the math, right? If we just had a couple of dollars to use this do day passes, right? So our whole goal there was to bring as much fun, action-packed stuff as possible to have them enjoy their stay as much as possible. So it actually, last month it got ranked as a number 1 RV park in Louisiana, which is pretty interesting, and a nice little pat on our back for the work that we put to get it up and running from, like I said, we bought it. It was from the 1970s. It looked like it hadn't been touched since the 1970s. So it was cool to put that in.
Great stuff. Well, listen, we lost Ryan, but we've got, as you said, the better half.
That's right.
And we thank Ryan. Lucas, thanks for joining us. We've enjoyed this conversation. If any of our listeners want to find out more about you guys and TR Capital Partners, what would be the best way for them to go about doing that?
Yeah, so I'm fairly active on social media between LinkedIn, Facebook, and Instagram. My handle is Lucas_Ravanis. Cool thing is I think I'm the only person in the world with that name, so it shouldn't be too hard to find me. You can always reach out to us on our website as well. It's trcapitalpartner.com.
Sounds great. Well, Lucas, thank you so much, man. I love the creativity. I love what you're doing, and keep it up. Let me know if there's anything we can do to help.
Will do. It's great chatting with you guys today. Thank you very much.
Thanks, man.
Thank you so much for listening and watching the Truly Passive Income podcast. If you liked the show, if you think it would be useful for someone else, the greatest compliment that you could give us would be to share the episode, leave a comment down below, or leave us an honest review. If you have any questions, don't hesitate to let us know down below. And remember, with truly passive income comes freedom of time, place, and the freedom to pursue your higher purpose.